Alright folks, let's dive into the big news from Germany's recent elections and what it means for investors. The Conservative Party's victory has brought immediate relief to European financial markets, easing concerns over political instability in the continent's largest economy. But the big question remains, can the new government implement the fiscal reforms necessary to revive economic growth? On Monday, Germany's mid-cap stock index recorded its biggest daily gain since late 2023, and the euro briefly reached its highest level in a month. Investors were clearly happy to see a potential coalition between conservatives and social democrats, which might make policymaking smoother compared to the outgoing three-party coalition. Stock markets reacted positively right away. Germany's small and mid-cap stock indices posted strong gains, rising 1.3% and 2.6% respectively. Meanwhile, the DAX index climbed 0.9%, outperforming the broader Stoxx 600 index, which tracks European stocks. Safe haven German bonds saw a slight increase in yields, reflecting greater investor confidence. But here's where it gets tricky. Germany's fiscal policy, particularly the debt brake, which limits the structural budget deficit to just 0.35% of GDP, remains a big concern. Critics argue this rule has led to underinvestment, causing Germany's economy to contract for a second consecutive year in 2024. Changing this policy is no small feat. The new coalition lacks the two-thirds parliamentary majority needed to amend the rule. One option could be to include the left party in negotiations, but they oppose increased defense spending, a key pillar of the new government's agenda. Far-right AfD and pro-business FDP, both against debt brake reform, performed poorly in the elections. This opens a door for potential fiscal flexibility, but likely at a slow and moderate pace. Experts suggest any fiscal reform in Germany could boost Eurozone stocks, which currently trade at discounts compared to US markets. But the lack of clarity on Germany's fiscal stance weighs heavily on investor sentiment. Michael Brown at Pepperstone noted that Monday's euro drop indicates skepticism about quick debt brake reforms. On the flip side, Emmanuel Cao at Barclays believes left-wing parties will push for fiscal easing, making some form of debt brake reform possible. But CDU leader Friedrich Merz is not in favor of drastically relaxing the debt brake, suggesting major shifts may take longer than expected. There's also the matter of increased defense spending, which could shift fiscal policy. Germany may need hundreds of billions of euros to modernize its military, potentially justifying additional borrowing even under the debt brake constraints. This prospect has boosted shares of German defense companies, with Rheinmetall stock surging nearly 4% on Monday. So while the Conservative Party's victory has brought short-term relief to markets, uncertainty over fiscal policy continues to weigh on investors and economists alike. The key question is, can the new government amend the debt brake to allow for greater investment and economic stimulus? There's room for moderate reforms, especially with pressure for increased defense spending. But resistance from fiscal conservatives may limit these changes in the short term. With markets still reacting to political developments, the next few months will be crucial for Germany's economy and the entire Eurozone. Now I want to hear from you. Do you think Germany's new government will succeed in reforming the debt brake? Or will fiscal constraints continue to hold back Europe's largest economy? Drop your thoughts in the comments and share this video so more people can understand how the German elections impact global markets. Don't forget to subscribe for more real, uncensored news and in-depth analysis.